Good morning, everybody. This is Mike Siccaranza with Affinity Wealth Management. We decided as a firm that we thought we'd try something a little bit different here, and instead of sending an email communication, kind of outlining what we're thinking and our thoughts, we'd try and use a video to kind of outline where we are in light of the recent market volatility and the coronavirus. We thought it'd make sense to shed some light on some of the behind the scenes of how we're managing your accounts, and also to let you know how that a major investment trigger has occurred and how it'll be affecting your accounts and here until things specifically change. I'm going to try not to get into the weeds on this too much. I want to kind of give everyone an overview and a historical perspective on why we're doing what we're doing, and outline kind of our process for those who are unfamiliar, although everyone should be familiar with how we're managing funds. And I first and foremost, I also hope that everyone is safe, and that if you need anything, your Affinity Wealth family is here to help in any way, shape, or form. So with that in mind, let's kind of just go through what our process kind of looks like. So first and foremost, let's look at how we construct portfolios. And one of the things, the two major components that we look at when we're constructing portfolios are relative strength and price momentum. And we've discussed this philosophy in the past and the reason why we use relative strength, and our next slide will show you one of the main reasons why. But let's talk about how we put it into practice. So step one is that we've created different risk levels for different clients. So we have an income model, a conservative model, a moderate model, and a growth model. And those models are comprised of 6 major asset classes: U.S. equities, international equities, fixed income, commodities, currencies, and cash. And I want you to think of those asset classes as teams. So if you're a football fan, think of them as, the Eagles, the Cowboys, the Redskins, the Giants. If you're baseball, think of them Yankees, Red Sox, Phillies. If you're, soccer, so think of them as teams. And basically what we do is, just like I say in college football, on a monthly basis, we rank those teams from 1 to 6, 1 being the strongest, 6 being the weakest. And how we do that is that we have all the players underneath the team. So using our baseball analogy, we have all the Yankee players play all the Red Sox players, and we add up the number of wins, and whoever has the most wins out of those asset categories goes first. Whoever has the least amount goes 6th. And what we'll do based off of your risk tolerance is we will overweight the number 1 ranked asset class as much as possible. Obviously, if you're a growth investor, you're going to be overweighted in that number 1 asset class higher, more than someone who's an income model. Because if U.S. equities is number 1, which it has been 90% of the time over the last decade, we can't have 100% of the portfolio for an income investor being in U.S. equities. It's just not, it's not right. It's not, the client cannot handle the risk volatility. But we do overweight as much as possible based upon your risk tolerance, using fixed income as kind of our governor. And we're looking at that monthly. And why that's so important is I'm going to show you why, because things have changed, and tomorrow is our monthly meeting to determine what the allocations are going to look like. So that's step 1, asset class, 20,000 foot level of your portfolio. Step 2 is figuring out who the players on the team should be. So I'm the manager of the Philadelphia Phillies. I got to pick my team, or I'm the general manager of the Philadelphia Phillies. I need to pick my team. And so we're picking the players. And so each one of those asset categories, so U.S. equities, international equities, fixed income, commodities, currencies, has a universe of investments that we're then choosing from to put in your portfolio. And once again, using relative strength to determine that. So I'm a Yankee fan, so I'm going to use some Yankee analogies. We want to own Babe Ruth and Mickey Mantle and Lou Gehrig and Derek Jeter and Aaron Judge over some of the other players on the Yankee teams that have been doing not quite so good over the years. So we have a universe of those things, and we're looking at those positions weekly, midweek, every Wednesday. So again, this video is timely because tomorrow is our midweek look at the different positions. So for ETFs and mutual funds, we look at them weekly. Stocks are a little bit different. I'm not going to get into this individual stock models today. This is because that's a smaller portion of our client base, but I really want to go over the big, broad investment strategies that we're going into place. And then rinse and repeat. So monthly, we're looking at the portfolios again, the allocations. Weekly, we're looking at the holdings. Now, why do we rank based off of relative strength? So this is an analysis done by Dorsey Wright and Associates going back to 1999, where they ranked the 6 major asset classes. And the one rule would have is that if you, at the beginning of the month, whatever was the #1 ranked asset class, you would hold that for a month and then redo the analysis. Remember, have all the teams play each other, and then based off of that, whatever's #1 again, you would invest in all your money in that. Not assuming capital gains and none of that stuff. Just, okay, we're always going to buy the #1 strength, and that's the green line. And you can see that in the yellow line is owning the top 2. So every month you do this analysis and you're owning the top 2 highest relative strength ones. And then the blue line is owning all 6 equally. And then the gray line is, okay, let's own the weakest. And what does that look like? And you can see there's over a long-term time frame. Doesn't mean your accounts don't go down. Doesn't mean that your investment didn't go down at times. But over a long-term time frame, you can kind of see that just owning the top-ranked asset class does way better than the yellow line or the blue line. Now, as advisors, we cannot stick, again, all your money in just the top-ranked asset class, and kind of Ron Cohen said, forget it. So we've developed this tactical tilt portfolio allocation to take advantage of that as much as possible within your risk tolerance. So we're trying to, eventually get to a point where we're somewhere between the yellow line and the green line overall. So that's why we do it. Now, why does all this stuff matter, and why do we focus on this on a monthly basis, and what's changed based off of what we're looking at? And that's the next slide. So the blue line is what happened on Friday. And like I said, going back to really 2010, 2009, whenever the market bottomed, that 666 bottom in the S&P, U.S. equities has been ranked #1 90% of the time. But you can see now what happened recently, and this is a bi-weekly look at the 6 major asset classes having those battles on a bi-weekly basis. You can see for the first time on Friday, domestic equities fell out of the #1 spot, in a really long time, really since 2016. So that signals to us that something materially has changed, and that U.S. equities is not the place we need to be for client portfolios right now, and that we are in more of a risk-off environment versus a risk-on environment. The feeling is right now is like, well, the market's already down 25%. Why would we want to make this allocation change? And the thing is, well, what happens if the market drops another 25%? Or, what happens if, we don't go anywhere for a really long time, but at least we can collect the coupon via fixed income? So, we don't play the guessing game. We have no idea what's going to happen going forward. We're going to use these rules, and one of the main rules is this one, to determine what our allocations look like. There's an old fundamental analysis versus technical analysis joke out there. They're both sitting in a bar, and a knife falls off the table and stabs the fundamental analyst in the foot. And the fundamental analyst looks at the technical analyst and goes, "Why didn't you catch the knife?" And technical analyst goes to the fundamental analyst, "We don't catch falling knives. We're technical analysts." And technical analyst goes back to the fundamental analyst and says, "Why don't you move your foot?" And the fundamental analyst says, "We didn't think it would fall that far." So we have no idea what's going to happen, but it's up to us, and it's up to being processed. And we're emotional about our clients. We care about all of you deeply. But when it comes to your portfolios, we cannot allow emotions to ride what we do. So the data is telling us now that we need to move out of domestic equities and into something more conservative. And hopefully the wish is that it's a V recovery, and a month from now we're getting you back fully deployed again. But we don't know if that's going to happen or not. So we need to make sure that you are protected. And I want to use the example of 2007 and 2000 through 2009 as a really good example of what's going on and how these transitions happen over time. And that, we're not going to time the tops and the bottoms. That's not what our goal is. We'd rather wait for some confirmation on the upside to start buying back in than just trying to, throw good money after bad. So this is the allocation changes. If you were in a moderate portfolio going back to 2007, so the first blue point is January of 2007. And you can kind of see that the ranking at that point was domestic equities was ranked number 2, actually, and international equities was ranked number 1. And really from 2003 to 2007, international equities was the dominant place to be. Think of all the BRIC countries and emerging markets and all. It was a good time to be invested internationally. And that's why international is ranked number 1. But you could clearly see really from most of 2007 that it was a risk-on environment, and that markets were performing well. The more conservative, more conservative teams of cash and fixed income are really towards the back end. Now you can still see that there's a 20% allocation to fixed income during that time frame because you're in the moderate portfolio. Again, if you're in the growth portfolio, you probably have no fixed income and you'd be all in international and domestic equities. But overweighted, so you're moderately aggressive, but as the year goes on, you can look starting towards November, things, even though S&P 500 held up fairly well in November and December, really into the beginning of the year, you can see underneath the hood, the players weren't performing quite as well as the record indicated, right? So there's all, consider it almost like advanced metrics in basketball or in baseball. And so you can start to see that even though the market's holding up, the equity exposure, at least on the domestic side, from when the market went from domestic equities rank went from 2 to 3, kind of shrunk. And then you can see by January, it fell even farther. And so as it continues to fall farther, your allocation towards domestic equities in this type of scenario would be very, very small. And you can see even by August of 2008, international had fallen off a cliff. It went from 3 to 6. And so we eliminate almost all exposure altogether. And the more conservative allocations kind of came into play. So currencies, fixed income, cash, even commodities for a while in the beginning of 2008 were ripping because think of oil. So we want to take advantage of that or take the risk off when it seems. And we don't know how long these things are going to last. I mean, basically, you would have been mostly out of U.S. equities for, in this scenario from January of really 08 through April of 09. Not so bad, right? And then you can kind of start to see, the U.S. market bottomed in March 9th, as a matter of fact. It was the 666 bottom, right, in the S&P 500. But you can see that the allocation back towards domestic equities, doesn't really start to ramp up again until maybe May, and really more so by September, although international turned much quicker, which is always, so you're, again, back to overweighted international and maybe having a little bit more of a bullish outlook relative to that. And then really it was 2010 when U.S. equity started to dominate the investment environment. So you can kind of see, and the analogy I like to use with these things and these changes in asset categories is, Michael Johnson, for the longest time, I think he is even still, is the fastest 400 meters runner in the world. And his time was like 45 seconds, I think was correct. But the Jamaican 4x100 relay team is 2 seconds faster. Now, the Jamaican team had to slow down to hand off the baton, from runner 1 to runner 2, and then speed up. And then had to slow it down from runner 2 to runner 3, and then had to speed up. And that's kind of what trend following and what we're doing here is we're never going to catch market bottoms and market tops. So if we ever do that, it's a Christmas miracle. But what we're trying to do is we're trying to take advantage of the trends. And so at bottoms and tops, we're going to be a little slow to get out and we're going to be a little slow to get back in. But that in between 60 to 80% move is when our portfolio should continue to try and catch up. So the question is, I get a lot of times, we're already down 25%. Why should we sell out? Why should we not, try and buy this falling knife? And the question is, we're down 25%, but you know what? We could go down another 25%. And we've now extinguished all our capital. I'd rather see some sort of confirmation that there's some more buying coming in. And for those of you who have been following me on LinkedIn, I've been talking about oversold, overbought. some of the other things, and we are possibly oversold. But is an oversold rally enough to get us back in? I don't know. We'll have to wait to see what the data looks like, because in 2008, it looked like things might be starting to get better, and then all of a sudden, the market fell another 30% after August. So I'm not comparing what's going on right now to 2008 outside of the portfolio mechanisms. Obviously, this is, financial crisis was a lot worse from a financial perspective. This is a health crisis. And lives are more important than money. But just to give you an idea of what the potential allocation changes could kind of look like. So that's why our indicators are saying get more conservative. We were within your portfolios, we're going to get more conservative. And that's the first reason why. So now the second reason is let's talk about the portfolio construction again. Remember I talked about each of the teams? So each one of the asset classes, those 6 that we talk about, we have a set of players underneath it. And I'm going to actually switch it up and go to a different, for those who are not sports fans, I'm going to talk about the Casey Kasem top 40, or if you're a little bit younger, if you listen to Hits One, there's a top 40 countdown of songs almost every Saturday, and that is a relative strength analysis. The most popular songs are at the top, highest relative strength. The worst songs, or the songs that are liked the least, are at the bottom of the top 40. Still good, but so what we've done is created a universe of investments for each asset category. And again, we basically have all the players play against each other. The highest number of wins, or the highest number in this case buy signals, goes at the top, and the least amount of buy signals go at the bottom. And basically what we do is we hold the top 5, and we'll hold them until they fall to the top third. So if we're talking about music, we're holding the Beatles, the Rolling Stones, Steppenwolf, Jethro Tull, The Who. Those are our top 5. Their songs during any particular year. But when they fall out of favor, so maybe a different band is coming up and they have a hit song, and so the Beatles fall out of the top third for Can't Buy Me Love, we're going to replace it with something else. Maybe it's Jumpin' Jack Flash. So that's how we're investing the ETFs and the mutual funds underneath the hood. Now, the one thing that is kind of the kicker on this is the money market. And I would consider the money market the Pat Boone of the investing world. Meaning that when that thing's rising up the charts, there's really something wrong with money or with music. And in this case, if money market's running up the charts relative to other things, that means we need to get more defensive. So when money market goes above the 50th percentile, that's a signal to us that even if, and this happened in 2018, even with U.S. equity still being the number 1 ranked asset class, money market got above 50%. We raised cash within the portfolios. We didn't sell everything, but we did raise a little bit more cash to be a little bit more defensive just in case. Well, let's look at what money market ranks right now. So money market right now is in the top 13, which means it's in the top 70th percentile relative to everything else. That's a huge warning signal to us. And that just happened, again, really recently. So what that's telling us is that, again, we need to be even more conservative. So not only is and I use a medical analogy, the X-ray and the blood work right now are telling us we should be getting more conservative right now. How long it lasts, who knows? What would cause us to make a change is money market starts dropping back down and U.S. equities start moving back up relative to everything else. So, and just a reminder for expectations and what our process is and is not, it's a means for identifying market leadership. U.S. equities have stopped being the market leaders. It's been the market leader 90% of the time over the last decade. It's not leading anymore. So we need to respect that. We're not just forecasting. This is based on current data. We're not trying to think the what if, I think, I believe game. So it's a means for identifying market leadership. It's an adaptive tactical risk management tool. We talked all about that just recently, and how when environments change, we need to be proactive and go from there. It's not static. So this is not the buy and hope strategy. You buy something, you hope it goes up. If it goes down, you hope it comes back. The way we can make the money back when the markets change, might be different, and what we invest in might be different. We've been overweighted tech for a really long time. Well, maybe tech doesn't lead us out of this rally. Maybe it's financials, or maybe it's oil, things that have stunk for 10 years. So we need to be adaptive from that perspective. Again, it's designed to take part in long-term areas of strength. We're not trying to pick tops and bottoms. Going back to that analogy of the Michael Johnson versus the Jamaican relay team, capturing 60-80% of the upside in a long-term theme of strength. But now the U.S. equity trend is broken. We need to respect that. So the bottom line is we're going to continue to follow our process. Hopefully this has helped a little bit to give you an idea of what we're looking at. And when we've had previous conversations where we said U.S. equity is still ranked #1, therefore we're not going to do too much. And we have done some stuff. We've sold. And I want to be clear that this is not. We have raised some cash in portfolios over time. When things have violated internally our sell discipline, we've replaced them, or even think of. We've got rid of international exposure, or a few weeks earlier. We've got so we have been raising some cash along the way. But now, to continue to follow our process, we need to raise more cash, and all portfolios are going to be heavily weighted into fixed income and cash, until these trends kind of change. So what would that look like again? It's once we see money markets slide back down the scale and U.S. equities retake the #1 position. Then we will redeploy in areas to demonstrating the most strength. Or even getting back up to #2 U.S. equities would certainly help. If things don't, unless we have a major rally today, U.S. equities is probably going to fall to #4 by tomorrow, which is, again, a true risk-off environment. So, like I said, this is kind of the end. I'm about 3 minutes over. We're here to answer any questions for you at Affinity Wealth. We are here to continue to guide you. Your financial plan is the primary thing that we're guiding on. The good news is, even despite this market downdraft, for most of you, your probabilities have not changed. Your goals are still on track. But we do want to make sure that continues to happen. We have implemented, we've talked in the past, our COVID process, which means that, we can do video conferences, meetings, we can do phone calls. And then, if you're scared and it's a scary time, call us. Let us talk you through what we're doing. Let us help you understand that you're, where you are in relation to your long-term financial goals. This too shall pass. One of our core values is community. So if any of you need help, please let us know. We can help you get the resources that you need. For our older clients, for clients who might be medically, at risk, please be safe. Please follow the CDC guidelines. Please take care of yourself, and we will make sure that we can do everything we can to assist you. Again, thank you so much. Sorry this ran a little bit long, but hopefully this is helpful.